Welcome back. We'll continue with India's 10 events after reporting period. Let's continue with illustration 6. A company has inventory of 100 finished cars on 31st of March 2022, which are having a cost of 4 lakhs each. On 30th of April 2022, as per the new government rules, higher road tax and penalties ought to be paid by the buyers for such cars, which were already expected to come, and hence the selling price of a car has come down and the demand for such cars has dropped drastically. The selling price has come down to 3 lakhs each. The financial statements of the company for the year 2021-22 are not yet approved. Should the company value its stock at 4 lakhs each, or should it value at 3 lakhs each? Ignore estimated costs necessary to make the sale. In the previous video, we came to know that as per Ind AS 2, inventory should be valued at cost or net realizable value, whichever is lower. Therefore, applying Ind AS 2 and considering Ind AS 10, because this government notification has come after the year end but before the approval of financial statements, whereas this condition is already expected to come as of the year end. So this is an adjusting event. So considering Ind AS 2 and Ind AS 10, this is an adjusting event and the inventory should be valued at rupees 3 lakhs each. Let's read the solution. Events after the reporting period provides the evidence about the net realizable value of the cars at the end of reporting period, and therefore the amount of 3 lakhs should be considered for valuation of stock. Hope this question is clear to you. In the standard, the illustrations itself are explaining the theory part. So I'm continuing with illustrations. If you feel that any particular point has to be discussed separately, please comment below. Okay, let's continue with illustration number 7. IBC Limited has purchased a new machinery during the year 2021-22. The asset was finally installed and made ready for use on 15th of March 2022. However, the company involved in installation and training, which was also the supplier, has not yet submitted the final bills for the same. The supplier company sent the bills on 10th of April 2022. When the financial statements has not yet approved. Should the company adjust the amount of capitalization in the year 2021-22 or in the year 22-23? See, here there is a condition that is existing as at the year end, that is on 31st of March, because the company has finally installed and it is made ready for use on 15th of March itself, and the company has already started its training and installation to its employees. But the secondary thing is bills from the supplier has not been received, but it may be received after the year end. See, the supplier sent bills on 10th of April, so there is already a condition that is existing as on 31st of March, which is further supported on 10th of April by bills. So this is an adjusting event and should be capitalized in the year 2021-22. Let's read the suggested solution. As per the provisions of the contract, the cost of installation and training of new machine is an integral part of the cost of asset purchased. Therefore, even if the details are available after reporting period, they provide proof about the circumstances that existed at the end of reporting period. Therefore, the cost of installation and training will be considered for capitalization in the year 2021-22. Hope this question is clear to you. Let's move on to next illustration. Illustration number 8. Company XYZ Limited was formed to secure the tenders floated by a telecom company for publication of telephone directories. It backed the tender for publishing directories for Pune Circle for 5 years. It has made a profit in 2021 22, 22 23, 23 24, and 24 25. Okay, 5 years. 1, 2, 3, 4. 4 years it has continued with this Pune Circle only, out of which 1 year is pending because Pune Circle was of 5 years. It bid in tenders for publication of directories for other circles Nagpur, Nasik, Mumbai, Hyderabad. But as per the results declared on 23rd of April, the company failed to bag any of these. So, these 4 tenders which has been launched in Nagpur, Nasik, Mumbai and Hyderabad has not been in favor of XYZ Limited, and hence the company hasn't get these tenders. Its only activity till date is publication of Pune directory. The contract of publication of directories for Pune will expire on 31st of December. The financial statements for the financial year has been approved by the Board of Directors on 10th July. Whether it is appropriate to prepare financial statements on a going concern basis? See, as on the date, this company XYZ Limited has no other tender that is available on hand to continue as a going concern. The only thing that it has is Pune Circle, which is also going to expire on 31st of December. Hence, considering Ind AS 10, this financial statements need not to be prepared as per going concern. However, if the management has alternative methods to alternative realistic plans to go ahead, then it has to be prepared as per Ind AS 10. Come, let's read the solution. With regard to going concern basis to be followed for preparation of financial statements, as per paras 14 and 15 of Ind AS 10 states that an entity shall not prepare its financial statements on a going concern basis if management determines after the reporting period either it intends to liquidate the entity or to cease trading, or it has no realistic alternative but to do so. Deterioration in operating results and financial position after the reporting period may indicate a need to consider whether the going concern assumption is still appropriate. So the management has to reassess whether the going concern is appropriate or not. If the going concern assumption is no longer appropriate, the effect is so pervasive that this standard requires a fundamental change in the basics of accounting, rather than an adjustment to the amounts recognized within the original basis of accounting. So if there is no realistic alternative, then the management has to assess whether going concern assumption is appropriate or not. If going concern is not appropriate, then the entire basis of accounting has to be changed. It is not just adjusting of figures by the events that has occurred. That is what it is saying. In accordance with the above, an entity needs to change the basis of accounting if the effect of deterioration in operating results and financial position is so pervasive that management determines after the reporting period either it intends to liquidate the entity or to cease trading, or that it has no realistic alternative but to do so. In the instant case, since the contract is expiring on 31st of December and it is confirmed on 23rd of April, that is after the end of reporting period and before the approval of financial statements, that no further contract is secure, implies that the entity's operations are expected to come to an end. Accordingly, if entity's operations are expected to come to an end, the entity need to make an adjustment as to whether it has any realistic possibility to continue or not. In case the entity determines that it has no realistic alternative of continuing the business, preparation of financial statements and thereafter on going concern basis may not be appropriate. So if the management feels that there is no realistic alternative, then there is no proper assumption that a going concern is to be appropriate. So going concern, if it is in danger, then the entire basis of accounting has to be changed. It is not just adjusting of figures. Let's continue with illustration number 9. In the plant of PQR Limited, there was a fire on 10th of May, in which the entire plant was damaged and a loss of 40 lakhs is estimated. The claim with the insurance company has been filed and a recovery of 27 lakhs is expected. Out of 40, 27 lakhs is expected. The financial statements for the year ended 31st of March were approved by the Board of Directors on 12th June. How should it be disclosed? So it is saying how this transaction has to be disclosed in the financial statements. You tell me whether this is an adjusting or non-adjusting. It is very clear that there is no condition that is existing as on the date of balance sheet, because fire is an unexpected thing, that too it has occurred in the May. So there is no condition that is existing as on 31st of March, and hence this is a non-adjusting event. However, if there is any significant impact of this inventory loss on the financial statement, it has to be disclosed as notes to accounts. Come, let's read the answer. In the instant case, since fire took place after the end of reporting period, it is a non-adjusting event. However, in accordance with Ind AS 10, disclosures regarding non-adjusting event should be made in the financial statements, that is, the nature of event and the expected financial effect of the same. Okay, and if the going concern assumption is also getting hampered, then the company has to disclose that because of this the going concern may be affected in future. So regarding that also, ICAI has given us suggested answer. So you might be thinking why this point came here. So in exam you should write the answer in all the possible ways, because of which ICAI has given some illustrations on to indicate the student how to present the answer. Come, let's continue with reading. With regard to going concern basis followed for preparation of financial statements, the company need to determine whether it is appropriate to prepare the financial statements on going concern basis. Since there is only one plant which has been damaged due to fire, if the effect of deterioration is operating, if the effect of deterioration in operating results and the financial position is so pervasive that management determines after the reporting period either it intends to liquidate the entity or to cease trading, or it has no realistic alternative but to do so, preparation of financial statements on going concern assumption may not be appropriate. In that case, the financial statement may have to be prepared on basis other than going concern. However, if the going concern assumption is considered to be appropriate, even after the fire, no adjustment is required in the financial statements. Hope this question is clear to you. Let's move on to the next question. Illustration number 10. ABC Limited declares the dividend on 15th of July 2022. As a result for the year ending 2021-22 as well as the quarter ending 30th of June 22, or better than expected. The financial statements of the company are approved on 20th of July for the financial year ending 31st of March. Will the dividend be accounted for in the financial statements 22-23, or will it be accounted for in the year 21-22? So this is an important question wherein many of the students will get confused whether this is an adjusting event or non-adjusting event. Come, let's slowly go through the solution and understand each and every point. The dividend is declared in the year 2022-23. Therefore, the obligation towards dividend did not exist at the end date of reporting period, that is 31st of March 22. Therefore, it will be accounted for in the year 22-23 and not in 21-22. Even if the financial statements for 21-22 were approved after the declaration of dividend, So it is saying dividend is declared after the year end, but the obligation to pay dividend has not been a condition that is existing as on the year end, and hence this has to be considered in the next year but not the current year, even if the current year financial statements has not been approved. Hope this is clear. It will, however, be disclosed in the notes in the financial statements for the year 21-22 in accordance with Ind AS 1. Mark this question as important and just revise this one or two times. Hope and you will be remembering this easily. This is not such a tricky question, but many students will confuse that the dividend is of 21-22, and people feel that if the dividend is of 21-22, there is an obligation to pay also, and it is an adjusting event in 21-22. So that is not correct. Even if the dividend is of the year 21-22, once if it is declared, then the obligation arises. Here in the question, declaration of dividend is after the year end, and hence the obligation also falls in the next year 22-23. So this event is non-adjusting event. However, in 21-22, company has to disclose that a particular amount of dividend has already been declared on so and so date. Hope this is clear. Let's move on to illustration number 11. What would be the treatment for dividends declared to redeemable preference shareholders after the reporting period but before the financial statements are approved for issue for the year 21-22? Whether Ind AS 10 prescribes any particular treatment for such dividends? So it is asking, you said in the previous question it is just a normal dividend which is given to equity shareholders, but here the question says you have declared a dividend on redeemable preference shares after the reporting period but before the financial statements getting approved. Whether this will be treated as, whether there is any specific treatment given in Ind AS 10 for such kind of transactions. Come again, let's go through the answer and we'll understand step by step. As per Ind AS 10 prescribes accounting treatment for dividends declared to holders of equity instruments. If an entity declares dividend to holders of equity instruments after the reporting period, the entity shall not recognize those dividends as a liability at the end of reporting period. This is what has been discussed in illustration number 10. However, Ind AS 10 does not prescribe accounting treatment for dividends declared to redeemable preference shares. As per the principles of Ind AS 32, a preference share that provides for mandatory redemption by the issuer for a fixed or a determinable amount at a fixed or determinable future date, or gives the holder the right to require the issuer to redeem the instrument at or after a particular date for a fixed or determinable amount, is a financial liability. It is simply saying that redeemable preference share is a financial liability as per Ind AS 32. That is what it has said. It has given the definition of financial liability over here. Thus, dividends payable to such preference shares are recognized as expense in the same way as interest on a bond. Since interest will be charged on time basis, the requirements of Ind AS 10 regarding the declaration of dividend not relevant for this recognition. It is saying redeemable preference shares is a financial liability, and since this is a financial liability, it is already existing as on the date of balance sheet and hence to be recognized as an interest on a bond. Whether it is declared or not, it has to be treated as an adjusting event and it should be provided for in the financial statements. Hope you people are clear with this. And there are few questions on test your knowledge. And okay, let's go through the first question. ABC Limited has announced its interim results for the quarter ending 30th of June. I hope this question has already been discussed in illustration number 1. Sorry, in our previous illustrations, wherein it has been clearly given that the board of directors approval date will be considered as a date of approval of financial statements. Okay, come, let's go through some Question number 2. ABC Limited is in a legal suit with the GST department. Hope you might have recognized this also. Even this has been dealt in illustrations. Hope you remember these. These two are in the previous video, not in this video. Next, continuing with ABC Limited. Third question. ABC Limited is trading in laptops. On 31st of March 22, the company has 50 laptops which were purchased at 45,000 each. The company has considered the same price for calculation of closing inventory valuation. On 15th April, advanced version of same series of laptops is introduced in the market. Therefore, the price of the current laptop crashes to 35,000 each. The financial statements 21-22 were approved by the Board of Directors on 15th May. The company doesn't want to value the stock at 35,000 less estimated cost necessary to make the sale, as the event of reduction in sales price took after 31st of March and the reduced prices were not applicable as on 31st of March 22. Comment on the company's views. The company is wrong because it has to be valued at 35,000 less the estimated cost to sell, because inventories has to be valued at cost or NRV, whichever is lowest. Similar question has already been dealt in illustrations, which is in our previous video. Please go through each and every question. Almost all the questions has been discussed in illustration. Let's go through this first question. XY Limited had made a large sized civil construction contract for a public sector undertaking valued at 200 crores. Execution of project started during 21-22 and continued in the next financial year also. During the course of execution of work on 29th May 22, the company found while raising the foundation work that it had met a rocky surface and the cost of contract would go up by extra 50 crores, which would not be recoverable from the contractee as per the terms of the contract. The company's financial year ended on 31st of March and the financial statements were considered and approved by the Board of Directors on 15th of June. How will you treat the above in the financial statements for the year ended 31st of March? You say whether this is an adjusting or non-adjusting. First, let's understand the question. In 21-22, company has signed a contract, civil construction contract, agreeing for 200 crores. But after the year end, that is on 29th of May, company found that there is some rocky surface and a cost of 50 crore rupees has to be incurred more, and the same will not be recovered from the contractee as per the terms of the contract, because the company has already agreed to 200 crores and it should not be changed at all. Now the company and the Board of Directors are asking you whether this 50 crores are to be treated in the current year or whether the same has to be considered in the next year. That is what the question is asking, whether this is an adjusting event or non-adjusting event. Come, let's quickly go through the answer. Simple question has to be accounted for. Okay, in the instant case, the execution of work started during financial year 21-22 and a rocky surface were there at the end of the reporting period. Though the existence of rocky surface is confirmed after the end of reporting period, as a result of which it became evident that the cost may escalate by 50 crores. In accordance with the definition of events after the reporting period, since the rocky surface was there, the condition was existing at the end of the reporting period. Therefore, it is an adjusting event and should be properly accounted for. Hope you are clear. We'll go through question number 5. A Limited was required to pay penalty for a breach in the performance of a contract. A Limited believed that the penalty was payable at lower amount than the amount demanded by the other party. So A Limited believed that the penalty was payable at lower amount, as other party is demanding higher amount, but A Limited believes that it has to pay only lower amount. Okay. A Limited created a provision for a penalty, but also approached the arbitrator with a submission that the case may be dismissed with costs. A Limited prepared the financial statements for the year 21-22, which were approved in July. The arbitrator in June awarded in favor of A. As a result of the award, the provision earlier made by A Limited was required to be reduced. Arbitrator also decided the cost of the case should be borne by the other party. Now, whether A Limited is required to remeasure its provision and what would be the accounting treatment of the cost that will be recovered by A Limited, which has already been charged to the profit and loss statement as an expense for the year 2021-22. It is saying that A Limited has a case which has been filed before the arbitrator, and arbitrator has issued an order in favor of A Limited. Therefore, the provision which has already been created by A Limited has to be reduced now, and also the cost for arbitration has to be borne by the other party. Now the question is asking whether the A Limited is required to remeasure the provision, and what about the cost that it has already been charged to the P&L account as an expense. So come, let's go through the each and every point of this question. See, in the instant case, A Limited approached the arbitrator before the end of the reporting period, who decided the award after the end of reporting period but before approval of financial statements for issue. Accordingly, the conditions were existing at the end of reporting date because A Limited had approached the arbitrator before the end of reporting period, whose outcome has been confirmed by the award of arbitrator. Therefore, it is an adjusting event. See how ICAI has framed its answer to say that this is an adjusting event. So likewise, you people need to read these answers, whatever given in our study material, twice, thrice, how many times possible you need to read and remember these words, because this is the way how a professionals write. This is what ICAI is expecting. Don't just write that this event has occurred before the year end and there is a condition existing as on the balance sheet date and therefore it is an adjusting event. What you people are writing is correct, but please frame your sentences in accordance with standard. Use some specific words given in the standard so that your answer will be like a good looking answer. A professionalism will come out. This is what ICAI is expecting. Okay, let's continue. Accordingly, the measurement of provision is required to be adjusted for the event occurring after the reporting period. As far as the recovery of cost by A Limited from the other party is concerned, the right to recover was a contingent asset as at the end of reporting period. As per Ind AS 37, contingent assets are assessed continuously to ensure that developments are appropriately reflected in the financial statements. If it has become virtually certain that an inflow of economic benefits will arise, the asset and the related income are recognized in the financial statements for the period in which the change occurs. If an inflow of economic benefits have become probable, an entity discloses the contingent assets. It is simply saying the contingent asset definition which has been given in Ind AS 37. So before writing that this right is a contingent asset and has to be disclosed in financial statement, just write few lines about the contingent asset which has been given in Ind AS 37, so that the examiner will understand that you have the knowledge of both the Ind ASs and you have a proper knowledge of how to link the answers with other Ind ASs. Hope you are getting my point. Continuing. On the basis of above, a contingent asset should be recognized in the financial statement for the period in which the realization of asset and the related income becomes virtually certain. In the instant case, the recovery of cost becomes certain when the arbitrator decided the award during 22-23 financial year. Accordingly, the recovery of cost should be recognized in financial year 22-23. So be careful while writing the answer. That is the reason why I have gone through this answer and I am explaining you only with the answer. Hope you people are clear with this. Let's go through illustration number 6. Question number 6 in test your knowledge. A company manufacturing and supplies process control equipment in entity to duty drawback if it exceeds its turnover above a specified limit. To claim duty drawback, the company needs to file application within 15 days of meeting the specified turnover. If application is not filed within the stipulated time, the department has discretionary power of giving duty drawback credit. Duty drawback credit has discretionary powers. Okay. For the year 2021-22, the company has exceeded the specified limit of turnover by the end of reporting period, but the application for duty drawback is filed on April 2022, which is after the stipulated time of 15 days of meeting the turnover condition. Duty drawback has been credited by the department on 28th June 2022 and the financial statements has been approved by the board of directors on 26th of July. Whether duty drawback credit should be treated as an adjusting event. See, the question says that if a specified turnover has been crossed, specified limit has been crossed, then within 15 days the company has to file an application for duty drawback credit. And if the stipulated time exceeds, then the department has discretionary powers. It may grant, it may not grant. So in the question it has been clearly given the company has exceeded the specified limit and it has filed an application for duty drawback after the stipulated time of 15 days. And now the company is asking that duty drawback has been created on 28th June and the financial statements are approved on 26th of July. So should I adjust this or should not adjust? Come, let's go through the answer carefully. In the instant case, the condition of exceeding the specified turnover was met at the end of reporting period and the company was entitled for a duty drawback, but the application for the same has been filed after the stipulated time. Therefore, credit of duty drawback is discretionary in the hands of department. Accordingly, the duty drawback credit is a contingent asset at the end of reporting period, which may be realized if the department credits the same. As per Ind AS 37, contingent assets are assessed continuously to ensure that developments are appropriately reflected in the financial statements. If it becomes virtually certain that an inflow of economic benefits will arise, the asset and the related income are recognized in the financial statements for the period in which the change occurs. If an inflow of economic benefits has become probable, an entity discloses the contingent assets. So, if you are virtually certain that an inflow will arise, then only you can recognize contingent asset. In accordance with the above, the duty drawback credit, which was a contingent asset for 21-22, should be recognized as asset and related income should be recognized in the reporting period in which the change occurs. When did the change occur? It occurred on 28th June. So, till 28th June, the company is not clear whether it will get duty drawback credit or not. And hence, a change occurred in the next year. So, a treatment should be considered in on realization will become certain in the next year and hence has to be recorded in the next year. Hope this is clear to you. Come, let's move on to the next question. Question number 7. Okay. XYZ Limited sells goods to its customer with a promise to give a discount of 5% on list price of the goods provided that the payments are received from customer within 15 days. XYZ Limited sold goods of 5 lakh rupees to ABC Limited between 17th of March and 31st of March. ABC Limited paid the dues on 15th of April with respect to the sales made on 17th of March. and 31st of March. Financial statements were approved for issue of Board of Directors on 31st of May. State whether the discount will be adjusted for the sales at the end of reporting period. Come, let's think over this question first. Hope you guys understood this question first. If payment has been received from customer within 15 days, a discount of 5% will be issued to the customer. And now a payment has been received from a customer before 15 days, and hence a discount has to be given. And whether this has to be treated as an adjusting or non-adjusting, just think and tell. It is like there is a condition that is already existing on the date of balance sheet, because the company already knew that it has to give a discount of 5% if a customer repays the amount, pays the amount of sales within 50 days. So there exists a condition, and after the reporting period a customer pays back. So company has received the amount within 50 days. So this provides an additional support to the condition that is existing on the date of balance sheet. Therefore, this is an adjusting event. Hope you are clear with my explanation. Come, let's go through this solution first. Question number 7. Yes, here it is. As per Ind AS 115, if a consideration promised in a contract includes a variable amount, an entity shall estimate the amount of consideration to which the entity will be entitled in exchange for transferring the promised goods or services to the customer. So it is saying, as per Ind AS 115, if there is any contingent, if there is any variable amount that has to be that has to be incurred by the entity to deliver the promised goods or services to customer, that has to be recognized. In the instant case, the condition that sales have been made exists at the end of reporting period, and the receipt of payment within 15 days time after the end of reporting period and before the approval of financial statements confirms that the discount is to be provided on those sales. So it is saying that there exists a condition on the date of balance sheet. Therefore, it is an adjusting event. Accordingly, XYZ Limited should adjust the sales made to ABC Limited with respect to discount of 5% on the list price of goods. Hope you people understood the question and the answer properly. Since there exists a condition on the date of balance sheet, you have to adjust this 5% discount on the list price. Therefore, this is an adjusting event. Let's solve question number 8. Whether the fraud related to 21-22 discovered after the end of reporting period but before the date of approval of financial statements 23-24 is an adjusting event. See, to the extent you people understood that it is reporting period means, events after reporting period means after the date of balance sheet, after the day and before the date of approval of financial statements. But in the question it is asking 2001 there is in the year 12 there is a fraud and the financial statements has been approved, published, but this fraud has been identified before the approval of financial statements 3-4. Whether this is an adjusting event or not. Come, let's check the answer and let's understand it slowly. In the instant case, the fraud is discovered after the end of reporting period 3-4, which related to 1-2. Since the fraud has taken place before the end of reporting period, the condition was existing which has been confirmed by the detection of same after the end of reporting period but before the approval of financial statements. Therefore, it is an adjusting event. Moreover, Ind AS 10 specifically provides that the discovery of fraud or error at the end of reporting period that shows the financial statements are incorrect is an adjusting event. Such a discovery of fraud should be accounted for in accordance with Ind AS 8 if it meets the definition of prior period error. So, what the answer is saying is this is already existing on the date of balance sheet, but you people discovered this fraud after the end of balance sheet date, that is after the reporting period. Hence, this has to be accounted for as an adjusting event, but considering the accounting treatment which has been given under Ind AS 8, that is prior period adjustments. Hope you people are clear, and I request you guys to please go through these questions, question number 5, 6, 7, 8, and we'll see question number 9. Okay. X Limited was having investment in form of equity shares in another company as at the end of reporting period. After the end of reporting period, but before the approval of financial statements, it has been found that value of investment was fraudulently inflated by committing a computation error. Whether such event should be adjusted in the financial statements. It is saying XYZ Limited is having investment in another country after the end of reporting period, but before the approval of financial statements, it found that value of inventory has been fraudulently calculated and it has been inflated by an error. The such event is an adjusting event. What do you people say? Yes, it is an adjusting event because there exists a condition as at the date of, because inventory's valuation has been done on the date of balance sheet and there exists a fraud, that there exists an error, but you have identified it after the date. So this is an adjusting event. Come, let's go through this solution also. Since it has been detected that a fraud has been made by committing an intentional error, and as a result of the same, financial statements presented an incorrect picture which has been detected after the end of reporting period, but before the approval of financial statements, the same is an adjusting event. Accordingly, the value of investment in the financial statements should be adjusted for fraudulent error in computation of value of investments. Hope you are clear with this solution. By this, we have completed Ind AS 10 events after the reporting period study material of ICAI, and mostly the compiler is also having almost all these kind of questions with changes in figures. Hope we'll discuss compiler little fast, and whenever I found any question that has already been discussed in these videos, in the previous video and this video, we'll just skip the question so as to reduce the time, so that we can save our time. Why we should discuss the same question repeatedly? So we will skip those questions which has been given, which has already been discussed, and we will discuss only the few questions which are new and which are like a case based questions. Hope this video is helpful to you. If you have any doubts, please comment below, and if you have any doubts regarding any particular point in Ind AS 10, comment below. I will respond to you, and if required, I will be making you a separate video on those topics also. If you like the video, please like, share and subscribe, and hit the bell icon to get the instant notification. Do share with your friends and help them to revise the study material and the compiler of ICAI. Okay then, bye bye. Thank you.